You've probably seen this happen, right? You get two financial gurus, they look at the exact same market, the same data, and they come up with two totally different lists of must-buy stocks. It feels kind of impossible. I mean, how can they both be right? Well, today, we're going to crack that code. We're going to dig into the different toolkits these experts are using to make their picks.
Okay, and here it is laid out for us. On one side, you've got the Fortress portfolio. I mean, look at these names: Coca-Cola, Johnson & Johnson. These are absolute titans, right? Then on the other side, you've got the growth engine, and it's all about tech powerhouses like NVDA and Microsoft. Now, what's fascinating is they only agree on two companies. So really, what is going on here?
And that is the big question, isn't it? How can they both be right? And believe me, this isn't just a simple mistake or a casual disagreement. There's something much, much deeper going on. To really get it, we need to peel back the layers and see how these analysts are actually looking at companies.
All right, so to solve this whole puzzle, we've got to understand the tools they're using. You can think of these financial metrics as the clues, the little breadcrumbs each analyst follows to build their case. So let's open up that toolkit and see what's inside. First up, we've got something called return on equity, or ROE. Now, put simply, ROE tells you how good a company is at turning your investment dollars into actual profit. Think of it this way. If you give a company $1, how many cents of profit does it spit back out? A high ROE? That means management is super efficient. It's the real engine behind long-term compounding growth. Okay, next in the toolkit is the PEG ratio. This is a really clever one made famous by the legendary investor Peter Lynch. It's basically the ultimate bang for your buck metric for a stock. See, it doesn't just look at the price you're paying versus the company's earnings. It goes a step further and throws in the company's growth rate and its dividend yield. And here's the magic number. If you see a PEG ratio below 1.0, that's a huge flashing sign that a stock could be seriously undervalued. And last but definitely not least, we have what's called the Buffett rating. And this is all about one word: moat. Like a moat around a castle. In the business world, a moat is a company's competitive advantage, the thing that protects its profits from all the invaders, aka competitors. This rating basically measures how wide and deep that moat is, telling you just how safe and durable that company is for the long, long haul. Okay, so we've got our tools, right? ROE tells us about efficiency, PEGY is all about finding value, and the moat rating clues us in on safety. Now, let's get back to our mystery and see how these exact same tools can lead to two completely different ways of thinking and two very different portfolios.
Yeah, and this table really just lays it all out, side by side. Look at the primary goals. The Fortress guy, he's all about capital preservation, not losing money. The growth engine guy, totally different. He's chasing future growth. So right away, you can see they're playing two different games, prioritizing completely different metrics to get there. So let's dive into the Fortress philosophy first. The whole mindset here is defense first. The number one goal is to protect your money. You do that by buying these incredibly high-quality, stable companies that can survive pretty much any economic storm. When the future feels a little shaky, this is the strategy you use. It's basically about building a financial bunker. And this is just a perfect example of that philosophy in action. Coca-Cola and Johnson & Johnson, they both get a Buffett rating of 5. That's the highest score you can possibly get. It means their competitive moat is almost impossible to breach, and that's exactly what a safety-first investor is drooling over. It's like having the two most heavily fortified castles in your entire kingdom. And then get this. Look at AbbVie. It has what's called a margin of safety rating of over 40%. Now, what that means is our expert believes the stock is trading at a huge discount to what it's actually worth. For someone building a fortress, this is like finding the Holy Grail. You get a top-tier company, but it's on sale. Doesn't get much better than that. All right, now let's flip the script and talk about the growth engine philosophy. This is all about playing offense. It's not about protecting what you already have. It's about going out and aggressively growing it. And you do that by investing in these hyper-efficient companies that are basically set to dominate the future. This whole approach is designed to catch the biggest wave of growth, especially when the market's feeling optimistic. And wow, nothing tells that growth story better than this chart right here. Look at NVIDIA's forecast for return on equity. It's almost 55%. Now, compare that to the rest of the semiconductor industry, which averages just 11%. I mean, that is just incredible efficiency. It's exactly why the growth-focused expert looks at NVIDIA and says, yep, gotta own that. It is simply in a league of its own when it comes to making money.
But here's the thing, growth doesn't always mean flashy tech stocks. Take a look at United Health. Now, this is a big, stable healthcare company, right? But it's been growing its dividend by more than 13% a year. That's growth in your actual income stream. It's a super powerful compounding force that our growth expert definitely wants to get a piece of. So, okay, we have two totally different playbooks, right? One is all about building an unbreakable defense. The other is about a high-powered offense. You would think these two investors would never, ever agree on anything. But that's where this whole story takes a really interesting turn. Because despite all their differences, their opposing goals, their completely different approaches, our two experts landed on the exact same two companies. It's almost unbelievable. These are those super rare stocks that somehow manage to check all the boxes for the fortress builder and the growth engine seeker. So let's break down why Qualcomm and JP Morgan are the bridge between these two worlds. Take Qualcomm. It's got an excellent Buffett rating and very little debt. That's music to the fortress builder's ears. But at the same time, it has a crazy high ROE of 38% and that low PEG score of 0.7, which gets the growth investor excited. And it's the exact same story with JP Morgan. It has a massive scale moat for safety, but it also has industry-leading profitability and that same awesome 0.7 PEG ratio. It's the best of both worlds. And this quote about Qualcomm really just says it all. You've got high capital efficiency, check, that's for the growth engine. You've got conservative balance sheet, check, that's for the fortress. And a compelling valuation, well, that just means it's a great deal for everybody. It really is the total package. Yep, same thing for JP Morgan. The premier scale moat makes it a financial fortress, no doubt. But that industry-leading profitability and the low PEGR ratio, that makes it a fantastic engine for value and growth. It's one of those rare companies that manages to satisfy two very different bosses. So after all this, what's the verdict? Who was right and who is wrong? Well, that question actually brings us to the final and honestly, the most important piece of this whole puzzle. And here's the big reveal. The experts, they weren't actually contradicting each other. They were just answering two different questions. One was essentially answering, how do I build the safest portfolio I can that still has some growth? The other was answering, how do I build the fastest growing portfolio I can that's still reasonably safe? See, different questions always lead to different answers. And that right there is the biggest lesson for any of us. It all starts with you. Step one, you have to define your goal. Are you building a fortress or a growth engine or something in between? Step two, you choose your tools. You prioritize the metrics, whether it's the moat rating or the ROE, that actually align with your goal. And then finally, step three, you go out and find the companies that match your personal mission. Because at the end of the day, the most important question isn't, what are the hot stocks to buy? The real question is, what am I trying to accomplish with my money? Once you have the answer to that, everything else starts to fall into place. So I'll leave you with this. What question are you trying to answer? Are you building a fortress or are you building a growth engine?